Everywhere you looked, you remember the media, the analysts, even the so-called market gurus, they were all screaming that there's going to be an imminent crash, there's going to be a global recession, and that 2025 was going to be the worst year where everything was going to fall apart. And this is very important lesson for all of us as investors because headlines can be loud, they can be emotional, and can often be completely disconnected from what the numbers are actually telling us. The reality has been very different from those doom and gloom forecasts that were being made earlier this year. Just because history says September is volatile does not mean that it has to be volatile or it has to behave in a similar way this year. Investors who succeed are not the ones who try to avoid it. They're the ones who have a clear framework and they don't get tossed around by emotions. All right, welcome everybody. Today is September 4th, and this is our live market analysis session. We've got a lot to unpack today from what's been driving the rally to what happened in August and what does September hold for us in terms of seasonality and what do we expect next with rates, inflation, and job market. And as always, nothing I share is investment advice. This is strictly for educational purposes to help you understand markets better and think independently when and how to invest. My goal today is simple. By the end of today's session, you're going to have more clarity on what's happening under the surface, not just looking at the headlines. You'll see how the same process that I apply to analyze the markets can help you cut through noise and invest with more confidence. So before I continue, I want to pause for a moment and think about the headlines that were happening last few months. Everywhere you looked, you remember the media, the analysts, even the so-called market gurus, they were all screaming that there's going to be an imminent crash, there's going to be a global recession, and that 2025 was going to be the worst year where everything was going to fall apart. And we saw bold headlines like global recession is coming. Is the stock market going to crash in 2025? Wall Street sell-off deepens as Trump sparks recession fears. There was things like Wall Street and global markets tumble over fears of US recession, so on and so forth. Even the very famous Robert Kiyosaki was saying that history's biggest stock market crash is coming soon. And at that time, if you guys have been following my webinars, I kept saying that I am not in agreement with this narrative. And if you've been with me in the past, you'll remember that I kept saying that the data under the hood is not saying what the doom and gloom media is saying. And this is very important lesson for all of us as investors because headlines can be loud, they can be emotional, and can often be completely disconnected from what the numbers are actually telling us. That's why we look beyond the noise into the real drivers of the market. And when we do that, the story becomes very different from what the headlines are actually suggesting. So while the headlines were screaming recession and collapse, here's what was actually happening. This is the performance of the key indexes year to date, so this year. And you'll notice that S&P 500 so far has returned a 9.4% return, NDX 11.5. This has certainly come a long way from the bottoms that we faced in April. Ever since then, S&P 500 has come up by 34%. And NASDAQ at the same time has come up by almost 40%. So the markets have done really, really well. Now, obviously, we know that this has not been a smooth ride, right? So there have been turbulence. Market went down, then market went up, market went down. Like it's been up and down, up and down. But as we know, market essentially moves in waves. It goes up, it pulls back down, then it sometimes consolidates, then it makes the next move. But the bigger point here is that the reality has been very different from those doom and gloom forecasts that were being made earlier this year. The data that we were looking at through the webinars and that I've been discussing with you was actually showing strength, not collapse. Now, obviously, we don't know if it's going to continue going up, but there is some historical patterns that I would like to bring to everybody's attention. So let's talk seasonality because history tells us something very interesting. If you look at this chart that I have, September has consistently ranked as the worst month of the year in S&P 500 ever since 1950. So what I have here is a performance of the S&P 500 in different months, categorized since 1950, over the past 10 years, over the past 20 years, and post-election. And have a look. Since 1950s, the worst performing month has been September. followed by February. If you look at the past 10 years, the story is also very similar. The worst performing month has been September, followed by December. Over the past 20 years, September is the worst year. Post election, which this year is, September has been the third worst performing. If you look overall, this is what September shows, that historically, it's not the best month of the year. There could be many reasons for it, right? There are many theories. Some people point this to portfolio managers rebalancing after summer. Others say it's tied to fiscal year or fiscal year end cash that's needed, or just investor psychology that's going into Q4. But whatever the reason is, the data is pretty clear. September has historically been choppy month for the markets. But here's what's important. And I want you guys to all take away, because I'm going to share this over the next few slides too. Just because history says September is volatile does not mean that it has to be volatile or it has to behave in a similar way this year. This is just for context. It tells us that you can expect noise in September, but that doesn't necessarily mean you need to panic when we see that noise. So now the last chart showed us September's rank as the worst month. This chart I have puts the same thing into numbers. So since 1950, what's been happening over the past 10 years, 20 years, and also post-election. Numbers wise, since 1950, on average, September has returned 0.68 negative. So negative 0.68%. Over the past 10 years, you've seen negative 1.96% in September. Past 20 years, 0.65% negative, and post-election, negative 0.7%. Again, this doesn't mean that we're predicting a crash or any kind of guaranteed losses. We really are not doing that. But it does tell us historically that September tends to be volatile and tends to give softer returns. And here is another warning sign that we should be mindful of. Something interesting happened in August. This is a chart that shows that if August had a strong rally, which was more than 1%, plus at least the August had 5 all-time highs in the same month, what would September bring? Now, interestingly, that's exactly what happened in August this year. I think the market, the S&P 500 went up by a little over 3%, and we definitely have more than 5 all-time highs in September. So based on that, check this out. So if August returns were that good, the September returns always since 1950 were negative. Let me say that again. Always since 1950, the September returns have been negative. Again, do we know it's going to be negative this year? No, we don't really know that. But this does show that if August has done really well, it is not uncommon for markets to take a breather, pull back. So that's why I keep repeating, we're not trying to time every wiggle. We're looking for patterns, seasonalities, and probabilities, and we want to frame our expectations accordingly, because as volatility happens or as volatility increases or shows up, it doesn't come to us as a shock. And that's why having a framework, a repeatable process matters so much, because volatility is always going to be part of the game. The difference is whether you have a system that helps you stay grounded. So ultimately, do you know how to take advantage of volatility or know what to do with the volatility? Because here's the truth. As I already mentioned, volatility is here to remain. Investors who succeed are not the ones who try to avoid it. They're the ones who have a clear framework and they don't get tossed around by emotions. And that's exactly why I have created a program that I called Amit Chandan's Modern Value Investor. It's a step-by-step process that I have developed through years of investing experience. And this framework is designed to help you think independently. It gives you the tools and filters for high-quality companies, analyze valuations in a structured way, and is designed for you to build a diversified portfolio with discipline. Instead of guessing, this way you'll have a repeatable process that you can return to stay grounded. This is more from an education point of view. It's not a process where, somebody like me sits and gives you financial advice or analyzes your portfolio. Now, here's a unique part, folks. I am teaching the first cohort live starting next week. You're going to learn in real time. You'll be able to ask questions directly, and I will show you how the framework applies to real companies. And if it resonates with you, I invite you to scan the barcode here or go to this website, prosperitypathawy.com, or I'm going to put a link to it in this description as well. So click on that. From there, you can book a one-on-one discovery call with me. On that call, I'll make an effort to understand your current stage in your investing, where you might be stuck, and we'll see together if the program that I've created is the right fit for you in your learning journey. The first cohort is limited to a small group. So if you're serious about strengthening your investment approach, I encourage you to book a spot with me. But I'll leave you with this. Many members of our community have already signed up to take advantage of this learning opportunity. So I'll ask you that, what are you waiting for? There's certainly nothing to lose. At the very least, we can have a conversation. Now, let's shift gears back and look at the economic data. Here is the US inflation rate going back all the way to 2021, which is a few years ago. And you can see that the inflation had peaked in 2022 July. Now, ever since then, obviously, the inflation has come down because the Feds have taken a lot of measures, such as increasing their overnight lending rate. And that increase has been the biggest part in the drop of the inflation. But notice what has been happening recently. Recently, the inflation, instead of going down, has actually been ticking up, right? And that's obviously, it's not as extreme as what we had in 2022, but this is not the right direction where the Feds want to see the inflation go. So here's a question. What is behind the recent uptick in inflation, even after all the Fed's rate hikes and the policy tightening that they've done? So one of the big reasons that the inflation has been going up or has been sticky is because of labor market. So let's take a quick look at what's been happening here. So on the left side, I have a chart that shows monthly job creations. So you'll notice that since 2022, the number of new jobs has actually been going down while it was pretty high in 2022. If you come back to 2025 now, you can see the price has not only slowed down dramatically. In fact, the May and June numbers, which are these two, were revised down by 250,000 jobs. So previously, the thought was that there were a lot more jobs, but as more data came through, the picture is not looking very good. So the actual job numbers have been very, very weak in the United States than they were first reported. On the right-hand side is the US employment rate. So after hitting a historic low employment rate in 2022, 2023, look what is happening. The unemployment rate has actually been going up. Now, while it's become somewhat steady here, still it's sitting at a 4.2%. Now, I still recognize that this 4.2% is still very healthy compared to historical standards, but the trend is what matters. What's happening is the labor market is cooling. Why is the labor market cooling? So here are a few reasons. Number one, the Feds did aggressive rate hikes from 2022 to 2023 because they wanted to cool the inflation. Because when the Feds raise overnight lending rate, that directly affects the short-term interest rates on things like line of credits or short-term loans, like the 1 to 3 year loans. Those are exactly the kind of loan or debt instruments that small and medium-sized businesses rely on to run their operations and ultimately to hire people. So as borrowing costs jumped, companies pulled back on their expansion, and that slowed down on hiring. Now, who can forget President Donald Trump's game of tariffs? These tariffs have not just had an impact on employment situations in other countries, but they've also had an impact on a growth in the price of goods in the United States. So it's actually hurting people in the US. And I think if this carries on, it's going to start affecting the money in your pockets come the Christmas season. Also, as we know, there are stricter immigration policies that have limited the supply of workers. And even there have been job cuts in the government, which are also playing a role. And of course, politics is adding a little more noise as well. As you remember, or I don't know if you've been watching, but President Trump recently, and he openly criticized this job data, which basically came to show how the market did not create that many new jobs, but he criticized the head of the Bureau of Labor Statistics who produces these numbers and ended up firing that person. So this kind of uncertainty does not build a lot of confidence in the business world. So overall, the story is this: the labor market has been softer, but this is giving Feds more room to consider cutting rates. The structural and political headwinds are still making it a little more difficult for companies to hire and let the hiring bounce right back up. So now that I've looked at the job numbers, let's connect this with the Feds, because ultimately the job of the Feds, which is United States Federal Reserve, is to control two things. Number one is jobs, and second is inflation. These are essentially the two driving pillars for the rate policy that they come up with. But before we dive into the numbers, I want to talk a bit about what just happened last week in Jackson Hole. Jackson Hole is Fed's economic symposium that happens in Wyoming. This is where central bankers, economists, and policymakers from around the world gather to discuss the big picture. This year, Jerome Powell made a very notable shift in his tone. He said the Feds are no longer going to be following the framework of letting inflation overshoot 2%, likely that happened after COVID. Back then, Feds basically said that if inflation were to run above 2%, they will let it run above it to counter those years when inflation was below 2%. Powell said that the approach is no longer relevant today. In plain English, it means that the Feds are not insisting anymore on focusing on inflation back over 2% immediately if it was below 2% before. Ultimately, what they're looking for is they're looking for flexibility, keeping inflation under control while also making sure that the labor market is sensible. That shift matters because it gives Feds more room to cut rates gradually without sending a message that they've fully given up on inflation. With that kind of context in mind, let's look at the current rates and the market expectations. So here are the Fed's overnight rate and where they currently are. Now, right now, we are sitting right here, which is 4.25 to 4.5%. Now, this is after some cuts that happened earlier this year, but followed by the fastest rate hike that happened ever in the history in the United States. Now, this rate where we're currently at, which is 4.25 to 4.5%, acts as a foundation for short-term borrowing costs across the economy. It influences things like credit, business loans, line of credits, even the yields that people get on their savings accounts. But as I mentioned before, mortgage rates are more closely related to long-term treasury yield, not the short-term. This impacts short-term. So short-term and even the money markets, which is like savings accounts. Because this has been high, the short-term rates has been high, and so have the money market or the saving rates. Still, Fed's fund rates sets the tone. So after the Jackson Hole that happened last week, the Feds have signaled that it's prepared to start easing off on this. Now, of course, they're still going to hope that the inflation continues to go lower or the labor market continues to cool down, which is the points that's going to impact them in cutting the interest rates. So now let's look at what the markets are thinking right now. This is the data as of today from CME Group, and it shows us the probabilities of rate cuts or what the rates will be in the upcoming FOMC meetings. The next FOMC meeting is going to happen this month on the 17th of September. Currently, the overnight lending rate is at 4.25 to 4.5%. They want to bring the probability of that coming down by 25 basis points is 95.4%. So 400 to 425 basis point, which boils down to 4 to 4.25%. Fast forward to the next FOMC meeting, which is going to happen on the 29th. As of today, the probability of another rate cut to 375 to 400 basis point is now sitting at 53%. Fast forward another 2 months to December, which is the next FOMC meeting. The probability of another 25 basis point cut at 350 to 375 is now looking at 43.2%. So if you remember, ever since the beginning of this year, we have been following this, and there has been an expectation of 3 rate cuts. But because of increased inflation, the Feds decided to remain unchanged over the summer, but looks like there is still that possibility of 3 rate cuts is still in the radar and could still happen. So we're going to wait and see how this happens, but you're going to notice that the stock market has been cheering this because the lower rates generally means cheaper financing and often higher valuation if the 10-year treasury yield goes down. But The bond market is watching this very closely as well. And that matters for all of us because the long-term yields, not short-term, long-term yields are what is directly tied to the mortgage rates. If the long-term interest rates go down, that affects the stock market in a positive way. Why? Because one of the formulas in when we calculate the fair market value of stocks or in valuation uses what's called discount rate. And the formula there is FCF, let's say FCFN divided by 1 plus R to the power N. And this R is a discount rate. So this is directly tied to the long-term treasury yield, 10-year treasury. So this goes down, the denominator goes down, then this whole fraction increases, which basically is the valuation. So valuations increase. So that's where the relation is. And later on, I'm also going to talk about how the interconnections happen. Now, folks, here is a long-term picture right now. This chart shows you what the market is expecting for the Fed's fund rates to happen over the next few years. So as you know, right now we're sitting at, in 2025, 4.25 to 4.5%. By the end of this year, as of now, so this is the expectation or the green line as of 27th of August. So the expectation is that by the end of this year, the market is going to, the Fed fund rate or overnight lending rate is going to go down to 3.7%. And then after that, it's going to go to 2.97%. So this is a difference of approximately 0.8. So if you divide that by 0.25, that shows that next year there's also an expectation of 3 rate cuts. The expectation is that after that, the Fed's fund rates are going to start increasing. Now, why will that increase? Because there's a possibility that by then the inflation might re-emerge or the growth suddenly rebound. So the Feds are going to come in and they're going to start controlling the growth or the inflation again. But the key takeaway is this. The market right now is not seeing this as a one-way street to permanently lower interest rates. Instead, it's a path of easing now, followed by potential tightening later. So for us as investors, this means opportunities, but also risks. Because if long-term yields don't fall as quickly as the Feds do their rate cuts, the mortgage rates and the bond market could stay tighter than people expect. And that's something we're going to watch very closely because that ultimately affects all of you who are homeowners in the United States. Now, I have a slide here that contains a whole bunch of items. And for those of you who are in our Telegram community, I sent this morning and I asked you guys to just do a little bit of research and see how these are interrelated. And I'm going to show you today how all these, which services, service costs, labor costs, inflation, overnight lending, long-term bond yields, stock market, mortgage rates, how everything is actually interconnected. So let's start off with where we currently are at. So currently, we know that the service costs, which is housing, rent, insurance, healthcare, wage, labor costs, tariffs, trade uncertainty, this is high. This is one of the reasons that's contributing to inflation, but they're also interrelated. Essentially, these are higher. The housing costs are higher. The wage and labor costs are increasing. What that does is that's directly related to inflation. So as this has gone up, inflation has gone up, right? And because inflation has gone up, this is where the Feds come in and by the book, they try to increase the interest rate, the overnight interest rate, so that the market cools down. Why? Because this way they know that companies are not going to be able to borrow, people may lose jobs, or their salaries may not increase as fast. So that starts to reduce the amount of cash that's publicly available. So that cools the inflation. So in essence, right now, the Feds have the interest rate, overnight lending rate at a higher level. When the interest rate is at a higher level, overnight one, this affects two things. It affects the short-term loans and line of credits because ultimately the Feds do not want the small to medium-sized companies to be able to take that money to invest in the economy. So ultimately lowering that thing. So the short-term loans and line of credits also increase in price. And when this increases in price because of the overnight lending rate, that also increases the money market fund rates. Money market fund rates is where a lot of people put their money. And currently $7 trillion is sitting in money market funds. And as the short-term loans and line of credits are high, this is directly connected to small and medium-sized companies hiring, so their hiring goes down. Now, at the same time, there is a relation with the long-term interest rates as well, because right now, long-term inflation is deemed higher. The interest in long-term bonds at this time is low. And when the interest in long-term bonds is low, guess what? It affects two things. Number one, the demand goes down. And when the demand goes down, the price of the long-term bonds goes down. And when the price of the long-term bonds goes down, because it is inversely related to bond yield, the bond yield goes up. And when the bond yield goes up, the mortgage rates go up. And this is essentially what's happening at this very moment. That's why the mortgage rates are high. Now, this is where feds are coming in and they're trying to do something. They're saying, well, this hiring that's happened, or the hiring is not happening as fast. So therefore, what they're trying to do is they're trying to increase hiring. So to increase hiring, what they want to do is they want to reduce the overnight lending rate. When they reduce the overnight lending rate, then the short-term loans and line of credits will have a lower interest rate. So this interest rate is going to go down. When the money market funds, their rate goes down. When their rate goes down, then suddenly people who are investing this money, the $7 trillion that's sitting in there, guess what? They're going to say, well, maybe I need to find better places to put this money. Now they will start putting this money potentially in the stock market if they think the stock market is going to continue doing well. And the second place where they're going to put it is in the long-term bonds, if they think that over the long term, the inflation is going to start getting curbed. If the money goes in the long-term bonds, then what happens is the demand increases. When the demand increases, obviously the price increases. And when the price increases, because the bond price is inversely related to bond yields, then the bond yield goes down. When the bond yield goes down, that's when the mortgage rates will go down. So folks, that I wanted to show you is the overall relationship. Now, here's another thing. When the bond yield goes down, bond yield is also known as it's called the risk-free rate. Risk-free rate. Risk-free rate is something that is directly inserted in the calculations of the discount rate that I spoke about recently. So when the discount rate goes down, then the valuations of the stocks goes up. And when the valuation of stock goes up, guess what? The stock market starts to grow as well. These are the intricacies that I wanted to share with you, that things are not necessarily right now sitting in isolation. So the reason why the feds are interested in cutting in interest rates in the short term is because they want to increase hiring. Earlier, they had the hiring and the inflation rate connected. But last week in the Jackson Hole, they decoupled it. They said, we also now need to look at hiring. So if we need to do something that impacts hiring in a positive way, we're going to do that. And what is that going to do? They're looking to cut the short-term interest rates, which is going to affect the short-term, or immediately it's going to start affecting the recruitment by these companies, smaller companies, but it's also going to start moving money that's sitting in money market funds. It's going to start becoming available elsewhere. Now, if you connect this back to a few webinars ago when I was talking about tailwinds, this is all that. There are tailwinds in the stock market that are pushing the stock market high. So right now, why is the market going up? These are the reasons, and they're all interconnected. So folks, thank you so much for spending this time with me. Hope this was knowledgeable. I will now open it up to questions.